Welcome back to Higher Exchanges. I'm your host, Jesse Redmond, Head of Investor Relations and Business Development at Leaf Brands. I'm joined this week and every week by Morgan Paxia. He's the co-founder of Poseidon. Morgan, how are you on this fine tariff-laden day?
I am healthy and present.
Yeah. You asked me how I was doing before the show started. I think my answer was, fuck, man, I don't know, but there's no actions I can take to change it. So here we are.
That's right.
Yeah. And Morgan, we are not alone. I'm excited to have another Poseidonite by the name of Colin Ferrian. Colin is at Saving Plants on X, and he's a portfolio manager at Poseidon in real life. Colin, what's happening, man?
Not too much, Jesse. Happy to be here. Appreciate you guys having me on.
Yeah, I'm excited to have Colin on the show. This was my idea. So any people that think that Morgan's out here trying to push the Poseidon team on me, that could not be further from the truth. I asked him to have Colin on the show, wanted to have Colin on the show for a while. I think Colin's a great follow on social media. You have a real high hit ratio, Colin. There's some guys that put out 10 tweets a day, and one of them is worth reading. You put out maybe one tweet every week or two, and they're all worth reading. So if you guys don't follow Colin, check him out at Saving Plants. I don't see too much from you on LinkedIn, Colin, but I do see you active on X. And I also like Colin because I think, Colin, you're a humble guy, you're a smart guy, and you're one of the cannabis investing people that seems to really care about weeds. You put those all together, and I'm really excited to have you here.
Thanks, Jesse. I would say the same thing about you.
Well, thank you. So, Colin, how did you get into all of this? Why don't you take us back and tell us? I'm guessing you didn't go straight to cannabis. You seem a little bit too old to have gone straight into the cannabis investing world. So maybe you could tell us a little bit how you got started in investing and how you eventually migrated over to that intersection of cannabis and investing.
Yeah, absolutely. So I got my start in a pretty traditional finance path, working in banking, and then got lucky enough to get a job working for a long-short fund here in Boulder, Colorado, where I'm based. I worked on that fund for about 4 years and managed to actually cold knock my way into Patrick Ray's office.
Oh, really?
Once upon a time, yeah, at Canopy Boulder at the time. And I was looking for a change of scenery. Probably I wanted to get into operations a bit more. That seemed like you always have this situation with like analysts that, analysts want to work in operations because it seems like it's a little bit more hands-on. You can get more specific experience, especially if you're a generalist. And I had been underwriting on behalf of the fund some private investments into cannabis at the time. It's probably 2016, 2017, around that period. And it just seemed like there's a lot to learn in the industry, and I still think that today. So Patrick got me a role at a venture-backed company in cannabis. We were doing computer vision in the olden days, 2017, over plants, and trying to diagnose pathogens and diseases over cannabis plants. So I lived in a cultivation for about a year, doing scouting and all that sort of stuff to try and build the AI. And then transitioned to Urban Grow, which I was working on developing cultivations. And just after that, I worked with Mike Reagan doing bespoke equity research at MJ Research Co., which is great and got me a lot of the background experience that I use at Poseidon today.
And why did you care about cannabis? Like, what inspired you to go from the long short fund to knocking on Patrick's door?
Well, at the time, my thought was that I really wanted to be. I was a generalist focused at an event-driven fund, and the opposite of that is being a industry-specific person working in like a long-term strategy, like operations. So rather than calling quarters, you are, trying to make decisions about sustaining the business for as long as possible. And when I had first done some due diligence on cannabis, it just seemed like the kind of gap of knowledge was really wide, which it was at the time, I think. And probably still is today, but less so. There's much more education and information out there. But at the time, asking people what they thought cultivation yield rates would be, or what they thought that, your margins should be, or your inventory, your DIOs at retail should be, there's just like no institutional knowledge around it. So hence I thought there was a good opportunity there.
And what would you have done differently looking back? Like, would you have jumped in as early as you did? The reason I asked that, Colin, is today is Thursday, April 3rd. MSOs is down another 8% today. After the Trump tariff news, everything's been selling off, but it seems like MSOS goes down about 90% of the time. We're, over 4 years into this bear market, down 95% on the MSOS peak to trough. Just using MSOS because we lack another benchmark. I understand some investments have done better or worse. But some days, Colin, I look in the mirror and I say, oh man, why did you do this? And most days I wake up and I'm like, hey man, it's not awesome today, but still totally a believer and think this is going to pay off. How do you think about all of this? Like, you guys are really committed at Poseidon. Morgan and Emily have been doing this for over a decade now. Like, looking back, like, would you have taken a different path? And how do you feel sitting here today?
That's a good question. I think the answer is I wouldn't take a different path. I've thought about this a ton, especially in the midst of like the bear market. But I'm lucky for a couple of reasons. One is I enjoy the cannabis industry. The people that are in it have made a lot of good relationships, like you two, for example. And secondly, at Poseidon, we have a small group of us that are hyper passionate about this industry. And it's hard to kind of be yourself in a job. If you're having bad days, you can express it. If you're having good days, you can express it. And we get to do that at Poseidon, which is quite nice. But then on top of that, like, there's just constant curiosity. We have the saying called "take the call," which Emily really leads on, probably because she's the most extroverted of our group, which is a high bar that she sets, but we're not even close. So I basically, like, outside of that, I don't have a lot of exposure to the public markets at work, outside of just like the things that I enjoy following. And on the private markets, there's a ton of opportunity in investing in cannabis. If you're willing to do the work and really understand what you're underwriting. And I've learned, I joke with Patrick, who I work closely with on the current fund we're allocating, but you learn new things every single day. And it's not necessarily cannabis new things, but about structuring deals, everything from like legal to finance, to just underwriting and communicating with people. So I don't know if I would have gotten into it earlier. I'm certainly glad that I got into it when I did, because it got me to this place.
You said it was 2016-ish when you got in?
Yeah, probably around that in 2017. Yeah.
Yeah, that was about the time that I closed the hedge fund stuff and started a dispensary. So similar paths in that regard. And just one more question, Morgan, then I'll toss it over to you. But what do you do on a day-to-day basis over at Poseidon? I know you guys, pretty well. You've gotten to know the whole team pretty well over the last few years. But I think some people might be curious, what does a portfolio manager at a cannabis investment fund do?
A lot of different things, but my primary roles are to underwrite our private investments that we're making right now. Those are mostly in physical businesses currently. We do all sorts of investing, from technology to products, but we're focused on physical assets like dispensaries, and to a lesser extent, it could be cultivations and grows, but vertical operators and dispensaries primarily. And underwriting involves basically figuring out if the investments make sense for us, and then if they do, structuring them in a way that we can make sure that we hit the returns that we target for those investments.
And just one last question, Morgan, before I actually hand the keys over to you. Any disclosures you need to make, Colin, about stuff we're going to talk about today that might be in your personal account or conflicts?
Yes, absolutely. So just first off, none of this is investment advice, as you guys do on the podcast every time. My views do not express, I'm not expressing the views of my firm. So I'm going to be really specific about that, because we're going to talk about a lot of public company stuff on this podcast. And I'm not super involved in that, outside of just, again, as I said, my personal interests. I am long Green Thumb, Weed Maps, Chicago Atlantic, and I'm short IIPR.
Okay.
In my PA.
Great.
Right. All right. Well, good to have you on, Colin. And yeah, the work never stops at Poseidon for sure. And what I think is interesting though is we do have a lot of focus and work on the private side, but we're always looping it full circle, right? I mean, it is an industry, and so whether it's a public or a private, they're just companies to us, and so we're trying to look at them and working with companies and the last several years, call it since COVID, equity, especially public equity, has been non-existent, and we've seen a proliferation of credit flow into the space, pretty quickly and pretty aggressively. Some of that is seeming to come back around for some of the groups that they put credit out to, and some of these issues are starting to percolate to the surface. We've had a pretty active period here with companies actually going into receivership, and the implications that is having on some of these public debt groups. One that comes to mind is one of the longest running, maybe the longest running, which is really a real estate focused group, but is IIP. And I know you just disclosed your short, but you've been, way ahead of the curve on this one, trying to highlight the issues, talking about, what they stated as their, what they were current on rate versus not really, because of some of the things that they were doing, and trying to extend that out as long as they could. But, it seems like they're running out of time on some of those issues, and now they're coming into having to deal with some big decisions here. So give us a rundown on what's going on there, and what you think they might be trying to do to work through some of this.
Yeah, absolutely. So I'll first give like a bit of background on IIPR, and then we can talk a bit more about where do they go from here, as well as I've got thoughts on the three other major public credit companies. So just as Morgan mentioned, the reason why I like to watch these is because it gives a lot of great insights into what's going on in the private markets, because a lot of these companies will have exposure to private companies, whether it's through leases or loans. So taking it back to, maybe setting the stage here. This is the first time that we've seen a real divergence among the REITs, with IIPR showing the most distress. But in the past, we've seen kind of like cracks in the armor, but it hasn't caused like big issues. They've been able to like amend the leases, and we'll go through exactly like how that's done, at least at a high level, and the strategies that all of the REITs are taking here. So just starting with the IPR distress situation and how we got into that. About, late December, the largest client at IIPR, who is PharmaCann, they represent 17% of the rent at IIP, defaulted across all of their leases. So that was about 4 months ago. A month after that, IIPR announced that they're going to have a partial recovery from PharmaCann. PharmaCann would hand back a third of the lease portfolio and then take a 5% rent cut on the rest, which is a reasonable outcome for your largest client, basically defaulting on everything, which is like a very unique game theory strategy for PharmaCann to take. I think in retrospect, we've found that it was maybe a little bit less strategy and more just liquidity issues. But so a month later, they create this amended deal. 1 month after that, 43 days, that amended deal was moot because PharmaCann fully defaulted again, and the rent stream was entirely wiped out. So basically 17% of rent disappeared in, call it 3 months or 2 months at that point. 2 weeks after that, which was last Friday, IIPR issued a after hours press release. So right before
Friday night dirty.
Yeah, exactly. Right before the weekend. There are very few people that it's less likely that people will read your press releases if you issue them after the bell on Friday. And they called it their tenant refresh plan. That included defaults on 4 more clients that represented 11% of rent income, as well as 16% or $16 million loan that was fully impaired. So all in, we have 28% of IIPR's rent has evaporated in 3 months.
And it doesn't stop there, because it's not just the loss of rent, but then it also flips into becoming a carrying cost for them as well, right?
Yes, it does, and that's a good. It's a good segue into what they do now. But actually, there was maybe just one point if I could touch on the. There was, I think maybe there were people that had described this as IIPR being aggressive or disciplined about their clients in doing this tenant refresh strategy. And I think if you guys are open to it, I'd like to explain why I don't think that's the case.
Yeah, I'm kind of laughing to myself about this being how you framed it, but go ahead.
Yeah. So I think what IIPR wanted to show the market was that they're being disciplined and like taking, if anybody else defaults, we're going to, or if like stops paying us, we're going to default to you immediately. So what actually happened with those 4 clients is meaningfully different than any sort of aggressive strategy. I'm going to use Forefront as an example here. And there's a lot of nuance to this, but bear with me for just a second here. Forefront had first, so I think going back to November of 2022, Forefront got their first amendment on their loan, on their lease with one of their leases with IIPR. So that was, call it 3 years ago now. 6 months later, they got another amendment, which is basically the security deposit covered half the rent. It's basically a 0% loan that gets repaid over 12 months. They defaulted on that 6 months later, January of 2024, and IIPR amended all 4 of Forefront's leases, basically a temporary rent reduction and security deposits applied. And the way they did it is they said, you can pay more rent in the future but you don't have to pay rent now. So to the shareholders, it looks like there's a bunch more rent that they can capitalize in the future. And this client this tenant is fine for now. There were a few more versions of this. April 2024, another 1.6 million in capex was provided. Rent goes up on paper. They give Forefront more cash. October 24, the first month that the rent reduction that they had amended in January ended, Forefront didn't pay the entire rent, and security deposit was applied again. So in the past 3 years, they had 5 amendments to the lease. Rent increased on paper. They had a bunch of concessions, and IIPR added 40% more capital into the Illinois grow with that they had cut the ribbon for in November, and then fully defaulted last week on it. So it made it maybe 4 months, or call it 5 months. So this kind of goes back to this extend and pretend strategy that we see from them. And it's not like this is unique to any given REIT. This is a common strategy. I just want to be really clear about, and then I guess you can even take the other 2 or the other 3 clients that IIPR defaulted on. Gold Flora, I don't think made it longer than 12 months on any of the leases with IIPR. So they didn't really have a chance to amend and extend. And Tilt had various lease amendments and deposits applied over the period. So it's, that's basically the strategy that's been going on. And again, not unique to them, but this is not like they're finally dropping the hammer on their tenants.
Right. Right. And they have yet to do anything about their dividend, right? They haven't cut that yet.
They have not. And I'm not a REIT investor, so I don't know how much they cut the dividend or what happens there. I focus primarily on the clients.
Yeah, no, I mean, just for REIT status, you have to distribute, what is it, 90% of your OFFO or whatever it is. I don't remember the specific of a REIT, but if they've lost, a good chunk of their revenue, then it naturally means the dividend has to follow, because it's not distributable anymore at that same rate unless they were to lever it up to try to cover it up. But why would they do that unless they were able to re-tenant and in an efficient way without a huge amount of cost, which seems like a very low probability in this environment. So, from a not trying to get into too specific being a position that you're short, but I mean, it seems inevitable that it will be cut. It's just a question of how much it will be cut. If there's more stress in their system, how far ahead of that are they going to get? Are they going to wait for more defaults and then do? But I've seen this before. I remember back in the financial crisis, we saw REITs having to slash dividends. Back in those days, watching that meaningfully, because anytime the REIT yields got over double digits, it was like an immediate red flag of stay away and be careful, because it's a very high probability that those rates that dividend has to be cut. It's not sustainable. What's been interesting, and then we'll pop into the other debt groups, but we do look at how the credit has been trading across these names. We get a debt run every week from our colleagues at Ventum, which is great, and IIP's debt still trades great. So I mean, I think it's the ask of the last I saw was like a 7.3% yield to maturity versus other credit in our space. I know the top groups still trade very tight, even though high yield spreads are blowing out. So it doesn't necessarily mean that there's risk yet. I mean, I think our debt markets are very illiquid, and so take that with a grain of salt. But very interesting that the debt hasn't moved at all. I mean, I would think that debt should be trading, a bit wider than that, and it really hasn't moved very much. But for people thinking they're getting a great yield by buying the common, it's highly questionable how sustainable that is and what it gets cut to, and what does that ultimately mean to the price. I mean, usually these things trade down more when the dividend's cut, if I remember right, and assuming markets still function similarly to how they do historically. We'll see. It's cannabis, so who knows? I think, yeah. So
to just on those points real quick, like the counter might be that the dividend cut is mostly baked in at this point. Like the low hanging fruit is out of the way in regards to that, and that may be true. And I think also if I was smarter or more interested in taking risk, I think like a pair trade of being long the debt and short the equity might be even probably a better path. But the reason that I'm still short is I think that in terms of the possible outcomes from here, like they will cut the dividend, but if that's mostly baked in, they can either re-tenant the facilities to cannabis operators, re-tenant them to industrial operators. So lowest probability is cannabis operators, probably medium probability is industrial operators, or cannabis operators, industrial operators. The highest probability is likely that these are zombie leases for a while, which I think causes them to leak a lot more value, even if there isn't that much near-term pain in that path.
Right. Because industrial, I think cap rates are like closer to like 8%, right? Not the 12 to 15. So
yeah, I think we're talking like north of 50% haircuts on the rental income for the industrial clients. And frankly, I don't know how much different. I did pan out like what a best case and worst case could look like for some of these facilities. But with a cannabis operator, you're probably you're not that far off. And with industrial, you have to decommission the entire location, which is a big added expense to these buildings. So if you take a 50% haircut plus the decommissioning cost, you're probably more inclined to re-tenant to a cannabis operator at a 60% haircut than just 50 to a traditional operator.
Yeah. One last piece on that too is when they would do these sale leasebacks, they were paying like 130% of market value to give these operators a lot of cash, and so the value of these assets are also very high versus what they would be in a more normalized pricing environment. So there's also that aspect. I don't know how much that factors into your analysis of where there's a true market value for their book versus what they've priced them at.
I think and this probably goes well with how I think it pans out from here. They have the best facility that is in IIPR's defaulted portfolio right now is Matson, Illinois, Forefront's cultivation. It's a great market to be a cultivator in if you've got the license. And there are operators, probably private operators with money that could take it over. My best case is that this is like I think similar, like you're talking to 33% to 50% haircut on the NAV. And then the rental income, again, you probably assume like that same 11%, 10 to 12% cap rate. And your reduction in rental income is probably 40% best case. But your worst case is that Tilt facility in Massachusetts that they paid, I think like just south of, I can't remember. It was 350 to 400 a square foot in Massachusetts that they paid for the facility. There are empty facilities all over in Massachusetts. I think that's probably a 75% discount.
Yeah. So anything else to touch on from the other lenders in the space? Where are they in this kind of debt cycle, the default cycle? How are they managing differently, or how does the landscape look?
Yeah, absolutely. So the other three are AFC Gamma, New Lake, and Chicago Atlantic. AFC Gamma is going upstream on their lending, so they're focused on lending smaller amounts. They said in the Q4 call that the sweet spot is between 10 and 40 million for them, which is on like the smaller side relative to IIPR or Chicago Atlantic. I think New Lake could play in there, but I'll get into New Lake in a second here. Their portfolio quality is, I'd say, like it's medium. They found a new CEO, I think it was a year or two ago, from Dan Fromesend.
Yes.
Yeah. And he inherited a pre-distressed portfolio. Probably it was like in the worst shape of all of them. He has found a path to basically grow that book with better operators and in kind of different sets of structures, while working out and remediating the distress in the existing portfolio. So I think they have a unique path forward with that strategy. New Lake is, they haven't given a lot of commentary on how they expect to change the business just in the midst of the distress. But I did want to add, like, they may have the best quality portfolio of the group. And within that best quality portfolio, they have PharmaCann, who's one of their smaller clients, I think second smallest. Calypso, who has not been paying rent for 6 months. Rev Clinics is in receivership. That's basically 14% of rent that we won't see, I think, like probably by next quarter, if not by next quarter, the quarter after that. So again, that's the best. However, they've done a really good job of what they amended their lease with Rev Clinics in Massachusetts and lowered rent by 40 odd percent, very rough math through that process. So I think re-tenanting will be easier there because they won't have such a meaningful incremental change to the rental income or the yield required for that facility. And then finally,
but similar issue though, that it still is Massachusetts, and
yeah, exactly.
how much demand is there?
It's hard to lease it, but it will be better than going from, again, like round numbers, going from like $1 million to $500K or $1 million to $300K is a lot harder than going from $500K to $300K in monthly rent.
Yep.
And then last is Chicago Atlantic, who they had some really interesting comments on their Q4 call talking about their focus on quality of cash flows. They are the only lender, I believe, that to date has said that they view unpaid 280E as a form of indebtedness. And they actually have limitations on the amount of unpaid tax liabilities that companies can accrue over the course of their loan. They do this via like leverage ratios or fixed charge coverage ratios. But they only have one client on non-accrual. And this all ties back to the game theory within the creditors, is that Chicago Atlantic has one client under non-accrual because if their clients default, they take the keys. And IIPR, New Lake, AFC Gamma specifically are prohibited from being able to take over these operations. So if you're an operator and you're wondering if like maybe I'm going to hold off on rent to pay X, Y, and Z for this month, With all of the other REITs, you probably get some sort of amendment or security deposit applied. With Chicago Atlantic, you could lose your operation. So they just have way more leverage than all the other peers, and could be like a possibility that Chicago Atlantic turns into a major MSO at some point because of this, which would be like an interesting outcome.
Is that really what like the Vireo kind of entity can become, as like a vehicle to absorb more operators that are hitting the skids that they can just, shift over there, or how are they able to take the keys that the others can't?
It seems like Vireo could be the path. The most common is like an opco-propco structure that these companies would take. And I haven't found like the direct read through to Vireo from Chicago Atlantic outside of like the equity interest and the management oversight, which is obviously a tight connection. But it's not as clear as like a joint venture type strategy that you would see in more traditional REITs. And again, I'm not a REIT expert, so this is my best guess, but it does seem like that if they wanted Vireo to be the anchor, and they've kicked off with these clients, I think 3 now that they are proposing to acquire, that could be like a great start to a much larger entity.
All right.
You wrapped up on credit there, Morgan?
Yes.
Okay, cool. Well, let's talk a little bit about pricing, Colin. And price compression is always a conversation we're having, but it seems to be getting even more topical. Morgan and I are in California. We've seen a ton of price compression here. Still keeps going a bit lower, but maybe that rate at which that is changing, is getting less. Colin, you're in Colorado. You can update us, but I know prices there have also come down a ton. I don't know exactly what the most recent trends are. And historically, the price compression in existing markets has been offset by new markets. So what was it, 23? What was it, 22? We had New Jersey. 23, I think, was Maryland. 24, we had Ohio. And those new markets come in, offer more revenue, and typically also at better margins because they're at higher prices. And then we see those prices come down. But the rate, Colin, at which they come down is pretty different. You have some like the Illinois that have stayed healthier. New Jersey has come down, but is still, at a healthy level. And so I think the reason I'm focused a bit more on price compression is because we don't have any meaningful new markets this year. Maybe we get lucky and Minnesota turns on late in the year. Maybe something happens with PA, but I don't think we can count on either of those. So what we're seeing, my expectation for earnings throughout the year is that we're going to continue to see margins come down because prices are going to keep coming down in these more mature markets. In some cases, they can bottom and start going back up, but they're not being offset by any new markets coming on that have the higher prices and the higher margins. So that's kind of my perspective on the margin conversation and the price compression conversation. I guess I kind of put those together because it seems like the price compression is starting to degrade the margins. So with that as a bit of preamble, what's your perspective on where we are in price compression across the U.S., Colin?
My view is a little bit different. And so when we started hearing all of these comments in this current quarter about price compression, which is the most that we've, I think, heard in maybe any recent past period about pricing just in general. And probably, Jesse, to your point, because we don't have these new markets coming online to kind of serve as a buoy while other markets decline. But so we went back and reviewed it. So, and just like a fun fact is we did go back and review it. Pricing was mentioned 155 times in the US MSO earnings. The next most notable trend that we watched is cash flow. That was mentioned 88 times. So about half in second place. But so to quantify this, which is kind of like a high level way to assess price degradation rates, we looked at 13 of the largest adult use states using headset. And I think there's 24 in total, but that includes like Montana and Alaska and others. So using 13 of the largest, we found that actually the rate of price decline in 2024 was an improvement over 23. And that was also an improvement over 2022 on average, meaning that the price decline was higher in 22 and then there was still a decline, but it was less so in 23 and then less so in 24. And this is because obviously this stuff you guys talk about in the podcast every week, scarcity of capital, people not building incremental supply, stuff like that. But I thought that was like kind of an interesting point. Of course, if you're an MSO or any operator, like you're focusing on a handful of markets you have presence in when you're talking about price declines. So I didn't go and do that for every single one of them. But it does seem like, when you zoom out and assess price degradation within these markets, it could possibly, it should at least be getting better than it has in the past, because there just isn't as much investment in the upstream in the supply chain, like cultivation, when these markets launch. And so in a market like New Jersey, the price decline, sure, there's double-digit price declines, but imagine how much higher that would have been if we would have been, 5 years ago in the peak of COVID, when everyone was investing in grows and standing up incremental supply.
Is there also, I'm thinking about this, that maybe it's getting to be more topical, Colin, because if you're growing at $700 a pound and things are at 2,800 and they go to 2,100, you're a little bit bummed, but you're like, oh man, I'm still making 3x on this. If it's at 1,400 and goes to 1,000 and then goes to 900, then goes to 800, those rate of changes of the drop are lower. But because you're getting actually closer to your cost of production, that makes people a little bit more skittish.
Yeah, that's a great point. So important to remember that within the MSOs that are reporting, most of them are skewed towards value products.
Mm-hmm.
And you heard just as much implied in the Q4 earnings calls, because a lot of them were talking about, we don't have as much presence in premium, and so we need to focus on it more. Curaleaf called it their Roots initiative, but this is mentioned by like Planet 13, AOR, Jushi, Vireo, a bunch of the others, that they just didn't have enough presence, and it's the best opportunity. I think Boris said the greatest opportunity to drive profitable growth in the face of pricing headwinds, something to that extent. So if you're on the low end, if you're on the value segment of pricing, and pricing drops from even 2,000 to 1,500, you're probably dropping from 1,800 to 1,000 for your SKUs within that market, which is exactly, I'm guessing that's likely the issue at hand here. And I mean, I'm also curious from like, given your experience now, Jesse, but like MSOs transitioning to premium is going to be, you have to have like a cultivation focused culture to be able to create. It's not, you can't just slap reserve onto a
Yep.
label and hope that it, garners a 20% premium on price.
Yeah, it's a weird world too, where everything's getting more expensive around you, except for cannabis in most cases. And so, cannabis in most markets is getting cheaper. And within cannabis, you have a whole range of options. In California, the cheapest, well, maybe not the cheapest, but one of the cheapest is what Glass House did with this Allswell brand, which is I think it's $9.99, under $10 out the door with all taxes. So that's more like a $7 or $8 eighth, before those taxes are put on. So you could spend, $10 on an eighth here, or you could probably spend $80 on an eighth out the door. And I think in an environment where everything else is getting more expensive, your food, your rent, your utilities, literally everything is getting more expensive. People look to cannabis and say, okay, where can I save a few bucks? And one way you can do that, is by smoking less. But I think a lot of people, Colin, there's this notion of good enough technology. And it's the idea there being, hey, I've got the iPhone 12, this new iPhone, 16 we're on, sure would be cool, but the 12 works pretty well, and I think I'll just stick with that. Within cannabis, I think that exists to an extent too, where if you have a $30 eighth in California, that's going to be pretty good flower. And for everyone except for the biggest nerds, that's going to work great. If you're a huge nerd, really love cannabis, or have a lot of cash, go spend, the $60, on the 710 labs or whatever you like, at that price point. But I think in this environment, Colin, there's an opportunity for people to downshift into cannabis. And I think people are generally gravitating towards the most THC, which all of us know is flawed, for the least amount of money.
Yeah, I mean, first off, it's that dynamic is so consistent across markets, but the good enough product. I mean, you all literally see bud tenders scoff at you purchasing the blue chip $60 eighths in Colorado when you could get what is the consensus belief is just as good product for 75% of the price, which is like, it's the funniest thing to see, because I mean, those blue chip products will still sell out, as I'm sure the 710s in California of the world will, here in Colorado. But you'd think that from an MSO standpoint, when you look at like the beer industry is like the common analogy, right? AB, InBev, and Coors are focused on the value in mid-tier segments because they have scale and consistency, so they can drive price with that infrastructure. So if you're an MSO, it seems like the easiest path, the path of least friction, would be to use your scale to provide consistent value products, and just accept that you're going to be subject to some price swings. But you're right, if you can't do that at $700 a pound, then you're probably going to leave a facility completely empty, like the ones in Massachusetts with some of the MSOs. Otherwise, it just feels like these MSOs are tackling premium products, they're tackling international, they're tackling hemp. Like, it's a lot of things to be experts at executing on.
Yeah, and one last point, nuanced point, then I'll pass it back over to you, Morgan, is I love markets, Colin, like California, where you can get actually really good flower at a lower cost because it's sun grown. So when I was building a menu for our dispensary here in California, we had outdoor, generally being the cheapest. Greenhouse grown flower was super popular. And that was, kind of the mid shelf. And generally speaking, the top shelf was the indoor. And the thing I hate the most in life, maybe not in life, the thing I hate the most in cannabis is bad indoor flower, because it's so expensive to grow. It's so bad for the environment. It's such a waste of resources. And to put all that effort in and get bad indoor is just, in my opinion, just such a wasteful thing to do. And so in markets like California, I think you can hit those price points really well and create those value lines really well. I mean, look no further than Glass House, right? Growing at about $100 per pound, largely because they're using, the sun rather than lights. But you take other markets like, Massachusetts, New York, all these other ones where there's really limited, Colorado to an extent too, Colin, right? There's limited sun grown options. So in my opinion, it gets a little bit weird when you're trying to create value lines from indoor flower.
Yeah, I couldn't agree more. It's also like it touches on why brand equity is so hard to build in cannabis too. So I think if you're a premium, like a couple points on this, if you're a premium producer and you're selling indoor flower that's priced at $60 an eighth, but the rest of the market is $30, the first time that one of your loyal customers buys a jar at $60 and it's stuff that they don't want or low quality, it will be really hard to get them back. So in Colorado, we see this revolving door of premium brands. I think that the lifespan on like the premium products is probably like less than a year, because everyone eventually has a mid harvest. It's just like, it's not as good as every other harvest. And it could be the same strain. Like, it was really good last time around and it's not as good this time. And I waited in line. I, paid, whatever, twice as much for it. Whereas if you're a consistent value brand, I mean, there's not going to be nearly as much complaint about, I paid $20 for this and it wasn't as good as the last harvest, but like, it's not the end of the world. I can go back and get more. Yep. It is the end of the world if you paid $60 and now you've got, a bunch of stuff that you don't want to consume. So that point really resonates with me. I think it's something that I haven't seen a lot of people really dig into, the kind of the lifespan of brands in the market and how quick they can disappear. But it's like the hardest. I have to imagine maybe the hardest part about growing flower is that you like staying on top and maintain your brand equity just requires so much consistency, maybe more so than any other commodity product, or that I can think of, maybe wine.
Yeah, it's a good point. And maybe why there's been more durability in brands in derivative products, because they're not as susceptible to that, right? Like, just still talking about California, like Kiva's been around forever, right? And they're not selling flour. They're selling gummies. And
the way I think about that too, Morgan, I think you're 100% right, but I also think about that when you're moving into new markets. So if you have cookies in California and Cookies actually grows it and they're growing fire, that's one thing. Cookies starts to contract grow in California and everyone else is growing it, it goes in a Cookies bag. That's another challenge, but at least you're in California. Now you take Cookies and you go to New Jersey and it's completely different people growing it, could be even different genetics. Replicating flower brands in other markets, in my opinion, super difficult. But take Kiva, make that in California, make that in New York. I bet that's 99% similar because you have the same chocolate, similar oil, all that sort of stuff. Yeah. So I think that's a good point.
Yeah. And the amazing part is like those ingestible brands relative to the inhalables can charge a similar premium over their peers. And in a lot of cases, like we still have Wana charging, maybe 20% over what the average edibles are here in Colorado. Now that average is like quite low, but it highlights the same, the same dynamic is it's probably a lot easier to be consistent. I do think that the argument that maybe between like the rosin and flower, like you can develop the most valuable consumer base over time if you can maintain that brand equity, could be something that would be like the counter in that argument. But beyond that, like, it's a return on effort for a lot of folks in cases. Are you able to do something like, can you create a premium product so consistently that you're going to have consumers coming back over and over just to like buy drops at a meaningful premium?
so as we're talking about this more established legal cannabis industry, one of the biggest variables that's probably hit us all in the last 12, 18 months has been what's going on in intoxicating hemp, and it's been proliferating all over. There's been a lot of stuff coming out about, is it really even hemp, or is it a lot of it is cannabis just being thrown in hemp bags and labels and being shipped around, or is it, is it got a lot of molds and pesticides and all this stuff and all these challenges, and the states are trying to catch up, but some states are just talking about banning, some are trying to do carve outs with alcohol. There's a lot of pushback. It's just very noisy, but there still is a lot of activity going on. Even was it just earlier this week, Organogram did the deal with, was it Collective Brands, which is a beverage I haven't tried yet. The labels do look pretty. Emily remembers them from years ago. And with the help of BAT, they structured a very, a deal we've seen quite commonly more in the nicotine space. They applied it to this transaction there. It does seem like there's some staying power around that category, but it is incredibly noisy, and there's quite mixed perspectives from even the MSOs, what they think about it. Are they getting involved? Are they not? So, what's kind of your thoughts on where's the intoxicating hemp sentiment at this point? And, how is that market functioning from like a capital perspective? Like what's kind of the Colin GPT rundown on it?
The sentiment is like consensus sentiment is super bullish on beverages. And, nothing that you guys don't know, but like in Q4, Trulieve launched a drink, Onward. Cureleaf launched, I think, seltzers and gummies. And then they mentioned the partnership with DoorDash. GTI continues to focus on it with Agrify. Probably one of the most interesting comments that I think that we heard in Q4 was from Cresco, and I can't remember who said it at Cresco, but when asked about if they were going to enter the hemp market, they said that that they don't believe that the margins are attractive enough to pursue when considering their other capital allocation options. So what they're saying there is like, if I've got $1 and I can spend it on growing our wholesale in Illinois with independent operators or doing shelf space partnerships or something like that, or I could go into hemp, we're going to take the former. But I think like the kind of the more implicit view here, which this is my words, not theirs, is that if they don't think that the margins are good enough now in that business to justify capital allocation, when would the margins get better? Because right now you have a consumer base that has completely inelastic on price. They have no idea what they should be paying, and they're happy to pay whatever it is. Because like the dosage is really, 2 cans are probably enough for everyone, most people, and that might cost you, 6 to 12, $10 on average for these companies. So you've got basically, consumers that are completely inelastic. You've got co-manufacturers who would prefer.
Yeah, let me pause you there. I might have beef with you on that one, Colin. Yeah. I think the beverage market is a massive ripoff.
I completely agree. Every time I hear you say this, it like resonates with me in a big way, because if we get edibles for our house, I'm doing the dollars per milligram. But the people that are like the incremental consumers that are not buying edibles and are buying beverages instead, I think most of those folks I see it in the liquor stores. I can't imagine paying like, $5 for 10 milligrams of THC when I could get 100 milligrams for $7 in Colorado. But I do think that the vast majority of consumers do not care. And they will eventually as they become more sophisticated. And this highlights like the nascency of this business now. The prices will get worse. The gross margins will erode. And all to say, like, how does this business get better than it is right now? Like, if you have the means to do it right now, why wouldn't you? Unless you were really confident in like the IRR of whatever other project it is that you're assessing. But I can't imagine, wholesale into a lot of these markets that are maturing is a better option. I don't know. That is very, I wouldn't say confusing, but like an interesting counterpoint to hear an operator make on their earnings calls.
Yeah.
I mean, it's a wild field right now. There's so many brands out there. Distribution is all over the map. Total Wine's definitely been one of the more opportunistic with allocating shelf space. Helps that they're private, so they can feel free to maneuver around a little bit more. But regulations are highly uncertain. How these states are behaving. One benefit they do get, to your point about kind of questioning that decision-making process that Cresco mentioned, is they don't have any 280E taxes. They don't have all these regulatory costs. They have nothing. It's so just right there, to your point, like that's likely to change, right? As these states do figure out a way that they want to resolve this, the cost structure is probably going to go up. Maybe that's part of their calculus, is that they're looking forward and saying, 6 to 12 months, these costs could actually come up quite a bit. And we could be seeing price compression because as the market just gets flooded with more and more, inevitably it comes down. It does, in some ways, it reminds me of the CBD boom and bust, where, some of these CBD grows were just printing cash, right? They had margins that, the MSOs were, just drooling over, and then they all went bankrupt, right? Or the vast majority of them went bankrupt, or now those that are surviving have very low margins and have found a way through it. But, I think the differentiator is it's just a form factor that a broad consumer base knows. And so there is probably some pricing potential longer term. And, we've seen this in just traditional beverage. What was it, Poppy, that sold to Pepsi? Was it a few weeks ago? Mm-hmm. And, most of them, the economics don't look great. It's just the consumer adoption, the market share, until a big brand wants to buy it, and then they plummet through their infrastructure and they get the costs much better, right? Because otherwise, all these are just highly inefficient, co-packing, subscale, with a lot of inefficient distribution costs and shelf space arrangements and things like that, where they can normalize all of that cost with almost a flip of a switch. And I think that's kind of the play that a lot of these hemp beverages are going for, is like try to build and do something. We've just seen such a lack of differentiation in their with a lot of the beverages, the flavors. There's some that are doing some unique stuff, but I think that's kind of the goal. And you were sharing a really interesting chart. I wish we could throw it up here on the screen, but just kind of looking at the underwriting, outcome between investing in like a grow versus investing in, taking the same dollar allocation and investing into several hemp brands. You have a high loss ratio, but one or two hit. It's kind of the old school VC playbook. Some of those work versus if you're in a good market, you have a certain cash stream that's going to come off of a cultivation that can yield a return to a much more measurable way. So just very interesting how it's like those kind of dynamics are all competing right now when we have such a scarcity of capital.
Yeah. Jesse asked, yes, we had a prep call yesterday, and I was explaining more of like a thesis that I had around cost of capital being meaningfully higher for physical assets than they are for hemp beverages right now. Because maybe just more anecdotally, it's really hard to raise capital for venture stage business in cannabis right now. It's just, no matter what you're doing, it's hard. But hemp beverages have seen more demand than anything else, like by a multiple of by a multiple. And so when I was saying this, Jesse asked, like, could you quantify what the difference is between the cost of capital on these two? And so you sent me into a rabbit hole last night where I was trying to figure out exactly what the difference in cost of capital is. And I think that there's tons of variables, so I'm not going to really get into like the specific percentages and whatnot. But I think if you're underwriting a hemp beverage, you're assuming that it's going to get taken out at at least $100 million business, and probably ideally you're talking a few hundred, 500, so on. But like you said, Morgan, the prospect of that happening is like, it's binary at best. And if, I think more likely it's, a 5% outcome. And there are funds within the industry that can guide that sort of exit better than others, or at least underwrite it better than others. But it does highlight like what we're focused on in cannabis right now is underwriting these physical assets. We can get, a return that we have a 75% probability of, or like confidence probability in receiving, as opposed to that 5% outcome. So instead of going to zero, we're going to get a good amount of the targeted return back, because these businesses are not meaningfully different from one another. They all cash flow pretty similarly. They have similar margin structures. If you're working in a grow, it's going to have great margins when the market opens, and then the margin will fade. And if you don't have a good team, it's going to be hard to keep it going when the state completely matures. Whereas in a hemp beverage, you can invest, and you can invest in a lot of these now. But if you don't have the ability to guide them towards a good outcome, it's going to be hard to get a good outcome on a lot of them.
Yeah, and last question I have on the hemp topic, guys. If you look into your crystal ball, Colin, and you look a year from now, what are your expectations around the hemp market in terms of what survives? And what I mean by that is I think there's getting to be a building of a consensus view that the low-dose beverages survive, but a lot of the other intoxicating hemp stuff goes away. What's your perspective on that THCA loophole and what you think survives in the intoxicating hemp market looking at 12, 18 months from now?
Yeah, with the disclaimer that I really like to focus on all things cannabis within like the fundamental bubble, and I consider policy and projections around policy outside of that bubble. So I don't spend nearly as much time on it. But what I do think you can underwrite from the past and push forward into the future is that I think that if it's either an all or nothing situation, I don't grasp the situation where the politicians really get the nuance of let's keep beverages but make everything else illegal. It seems like a lot of detail for people that, one, don't care, and two, have no interest in doing the industry any sort of favors. So I think a year from now, we either have a thriving hemp industry or no hemp industry at all. I really don't know which outcome occurs. I do think there's like enough scale at this point that it would be surprising if it was forced to completely disappear. And even if it was, how long does that really take? I mean, talk about like whack-a-mole, trying to get all of those smoke shops and gas station products out of those vendors. But I think that it's, with anything, it's probably like halfway in between what the consensus outcome is. But I'm curious on both the thoughts from you two on that.
Yeah, I think something happens. I think things are just getting reckless out there. And the more I learn about the quote THCA flower market, the more I see that's just emerging of the black market, the gray market, sometimes even the legal cannabis market, right? I mean, you can take a pound of any flower and turn it into THCA flower by having your teenager, generate a COA on the computer. And so people are shipping, hundreds of pounds across the U.S. with fake COAs and selling those as THCA flower in smoke shops, when in fact it's just cannabis grown from, California in many cases. So I think it's getting too reckless. I think there's too many minor cannabinoids that we just don't know very much about that are getting stuffed in vape pens, the HHCs of the world and other things that I haven't tried. But, it seems like people have some not so awesome experiences with them. So I think it's just an accident waiting to happen. So I hope there is some sort of regulation. I don't know that we'll get to it, Colin, because we're kind of chasing the clock right now. But you asked if we could have one thing we could fix about the industry immediately. What would it be? And for me, it's just really simple. I think it's one plant, one set of rules. So I think we need to merge what's going on in the state legal cannabis markets with what's going on in the intoxicating hemp market and just come up with one logical set of rules. And right now, the way I see it, largely is hemp is living, cannabis is dream, right? There's D2C options. You can advertise on Instagram. You don't pay 280E. USPS will legally pick it up and ship it to you. And those are all the things that happen in almost every other product in the world except for cannabis. But now you have this other thing that we're calling hemp, which in many cases is really just cannabis, that's operating by a completely different set of rules and giving a lot of consumers, access to products that may be inferior in some cases, but also a lot cheaper and making them a lot more accessible. So my guess is that something, will change. And I don't really understand, guys, the logic behind the beverages survive thing. It's one of those things think we say it enough. And it's just like, oh yeah, the beverages will survive. And it's like, I'm not totally sure why. I'm not against that happening. I'm not against low dose edibles, surviving as well. But again, I don't know that I can merge that with logic about why I think that'll happen. So I'm bad at political predictions. I retired after safe banking in the fall of 2022. That was fun. Fuck. But yeah, so I don't have any prediction there, but I'm hopeful that there will be some regulation, not just selfishly to help the state legal markets, but more so just because I feel like we're operating in a gray area there. And I'm not that scared, guys, of the just straight flower side of it. I mean, straight flower's been around for a long time. I probably smoked some weed with stuff in it that wasn't awesome for me, but I'm here and relatively thriving. So that part doesn't concern me as much. But what does concern me is when we concentrate those things, right? And so Leaf Brands is in the concentrate business. When we make concentrates, we concentrate everything. And even something that'll pass for flower in California, when we concentrate it, won't pass for pesticides as a concentrate because every part gets more concentrated. So now take that to the hemp market where you have something full of pesticides that wouldn't even pass in California as flower, and then you concentrate all of those more and you stuff them into a vape pen and somebody's smoking one of those every 3 days. That's just an accident waiting to happen. So for the consumer perspective, and also selfishly, I'm optimistic we see changes there, and my guess is that we will, but I don't have any edge in predicting that. What do you think,
Morgan? The reason beverage will survive, I can say with a high degree of confidence, is you got to remember politics is far from logical.
Right.
They speak to money, and money wants beverage to survive. Alcohol, tobacco, they have huge distribution, they have huge shelf space, they have an opportunity where they see the consumer shifting and they can own it, and that they are huge drivers of the changing of these regulations in that way for their benefit. I'm not a fan of banning. I think that's antithetical to our whole idea of legal cannabis. I think it's but it's a total disaster out there, as everything you said. I mean, not even talking about what's been getting shipped in from China. That's also a disaster. That's proliferating through the country, and it's only a matter of time before someone gets sick, and hopefully no one dies. But that's a reality. And are they going to sue that gas station that's selling it? Are they going to look at us? I have a feeling that we're going to bear that burden. So I hope these state attorneys generals get this sorted out sooner than later. If you want to put hemp in a retail store, a dispensary, I'm just a big fan of utilizing the plumbing that we have. And I know that doesn't work in every state because not every state has adult use legal markets. So that is an unsolved question. But banning without enforcement is a fruitless exercise. It's just nonsense. It doesn't do anything. It's not going to go away. And on all these actors that are cutting corners and doing all this gnarly stuff that's going to screw it up for those that may have good intentions, they're going to they just don't care, and they know that the lack of enforcement is just more time that they can keep doing what they're doing. So I don't know how they're going to go about cleaning it up. I mean, enforcement is a big issue that is lacking in general. Like any legal business that's paying all these taxes and dealing with all this regulation are getting none of the benefit from these states to be going in and enforcing the bad actors, whether it's hemp, whether it's illicit cannabis, whatever it is. I mean, those two circles are becoming more the same, where you're just seeing what was just illicit cannabis is now just hemp, and they're just calling it hemp, but they're growing cannabis and just calling it hemp. So but that's why I do see beverage surviving, and I do think it actually makes sense to live outside of the cannabis legal ecosystem, really, because we don't have, our regulatory infrastructure was not designed for beverage. These stores were not built, these grows, these manufacturing facilities, not the grow so much, but the manufacturing facility, we're not set up for that. So, it's much better infrastructure, and it's a consumer product that consumers want. So I just see that, having to solve that in a way that, money wants it being resolved. And so that's where it makes a lot of sense from a monetary perspective, not necessarily from a logical perspective, but, that's just the way the world works. So that's, that's why I'm just really confident it will find a way to survive and do just fine. And, from the pricing perspective, who knows? I think it's a really interesting point. We're just early in the game. I mean, you could also think of like the early days of all these craft beers. They charged huge prices for a very long time. And, eventually that, kind of wanes, and then they have to, pricing does come down. So I think, hemp beverage pricing probably will come down, but so will their input costs, other than tariffs and aluminum costs and stuff like that. But the actual ingredient of the intoxicating component will come down.
Can I one follow on that for Jesse? Jesse, at what price are you a consistent buyer of beverages? Dollar per can.
When they start paying me $1 per can to drink them. Yeah, to me, Colin, the whole thing's just weird, man. Like I don't like drinking things that get high.
Fair enough.
Yeah, so for me, like I'll eat an edible, sometimes for a discrete situation, but 90% of my consumption is vaporizing flower. The other 10% is some rosin here and there. I don't find the high from beverages interesting. I don't like isolate highs that much. There are some full spectrum ones, but what I like about flower is I know if I want to really be kick back, feel more sedated, couch lock, I got my GMO. If I want to be a little more, upbeat, I've got the train wreck. If I want to be in the middle, I've got my OG Kush. I know what to expect, and I can kind of tailor that effect and taste and all that stuff. Whereas with the beverages, to me, the high is boring. I don't like drinking stuff to get high. They're expensive. So honestly, I've got like 20 of them sitting right over there in a drawer, and I just don't drink them. I gave like 15 of them away the other day. So yeah,
market.
Yeah. So, yeah, and I'm not shitting on them. Like, guys, girls, whoever may not like flower, that's all good. If you love beverages, bless you. But to me, they're the least interesting category out there.
Gotcha.
You guys are true aficionados.
Well, we're bumping up on a deadline here, guys. So why don't we transition to the AI portion of the show? I love talking about AI because I'm kind of stumbling through how to use it in my own life. I'm using ChatGPT on a daily basis now, usually run up against that limit. So I should probably pay the $20 sooner than later. I use it to proofread things that I write. I'll give it a prompt. How can you improve this? give it some context. It's a professional thing. It's for a cannabis company, and usually get some helpful proofreading there, which is great. I've been analyzing financial statements. I'll upload financial statements and say, summarize this company's debt stack. I'll say, what are the red flags here? I'll ask about quarter over quarter changes. So nothing very sophisticated, but I'm kind of stumbling my way through it, much like search engines around 2000. You're learning how to use Google and Yahoo and Ask Jeeves back in the day. And so I'm having a lot of fun using them. Even I think we chatted when we were doing our prep session yesterday. I mentioned using them for movies. Like, here's my 5 favorite movies. Tell me 3 shows on Netflix I might like. My girlfriend was telling me that she was trying to make some banana bread, but wanted to adapt it to being keto. So she uploaded her favorite banana bread recipe and said, tell me how to make this so it'll qualify as keto. So there's a million and one great uses for it in our lives. And typically on the show we talk about Grok, because the show is kind of X focused in some ways. We stream on X, and a lot of our community is on X. But I know you, Colin, have been using more of was it Notebook?
Yeah, we use a lot of Notebook LM and ChatGPT at Poseidon.
Yeah.
But yeah, we use it. I use it every single day. I'd say the most common uses. The interesting example that we've done recently, that was kind of the onus for bringing this up in the first place, was we uploaded all the transcripts from the Q4 earnings into Notebook LM, which has a lot better kind of reference tagging in the AI, which means if you ask it a question like, tell me about the wholesale trends for all of the operators, it'll tell you about the wholesale trends and then link back to the source documents where you can click in and it'll highlight exactly for you what it said and basically how it interpreted it relative to the quote that might have been provided. So we use Notebook LM for a lot of the things that you really can't get wrong because ChatGPT will hallucinate on you if you put more complex documents into it. However, ChatGPT has been fantastic for if you want to do an initial draft of something legal, for example, and you don't want to pay somebody a bunch of money to do that before you go to a lawyer. It's great to be able to put a document through and have a sense. But even more so, I've found it's great for planning strategy. So, we get a document back, you say, okay, if I respond this way, what are the kind of various ways that person will respond? And then what should my action be after that? And you can kind of talk through, what each of the, if you can kind of tag probabilities onto outcomes, whether you're in a negotiation or trying to communicate something sensitive to somebody, you can go through all of that planning and be really, really prepared when you go into those conversations. So it's been super valuable. But the Notebook LM with the transcripts has been really fun because we can all kind of go back and forth and, you can ask very unique questions about Ohio had really interesting comments from Vext about pricing and the premium products relative to the more value-based. Or even the hemp comments that you might have heard. But I guess even UTP on certain tax positions was another great one where you can dig into these. So
you're uploading those all, Colin, then you're searching by these words where you want to see what different people said about them. Is that what I'm hearing?
That's exactly what we're doing right now. We're also, there's a little project that I'm working on where you can connect APIs to these documents if they're in something that's supported by a ChatGPT or Notebook LM. And if you connect those APIs, you can pull them directly from the source of whatever website it is that you're using, whether it's Quarter or Seeking Alpha or something like that. And then you won't have to necessarily upload them. You can just say, look at these 10 companies, review their transcripts, and tell me what they said about X, Y, and Z.
That's awesome. It's a good creative use. I haven't used Notebook LM yet. Have you used Claude? What is it? IS maybe? AI? Okay.
I have only used it a little bit, but I have the $20 a month for ChatGPT, so I try and really get my money's worth every month.
Yeah. And does does $20 do anything for me except for keeping me from hitting that limit where I get kicked back to the older model?
I've had it for so long that I honestly do not know what the free version offers, but I think the most valuable is like going to the O1 model and making sure that you're asking like complex questions that get very detailed certain answers on.
Yeah. Okay. Well, good stuff, guys. Morgan, anything else today before we wrap it up?
Do you want me to do my Ask Notebook LM, or are we out of time?
Oh, I didn't know you had an Ask Notebook LM. Yeah, let's do it. Colin, you have a couple more minutes?
Yeah.
Okay, cool.
I'll keep it brief.
Okay.
So utilizing what Colin had, he put 25 earnings transcripts from Q4 into Notebook LM. And so just for keeping it fun and simple, I said, what was the most commonly discussed risk and opportunity from these earnings transcripts? And it said regulatory uncertainty, particularly concerning potential federal reform, state level regulatory changes, especially regarding hemp-derived products, ongoing impact of 280E. And I won't go into all of those for time's sake. And then the most frequently discussed opportunity seems to be new market expansion and growth through strategic M&A activities. Many companies express excitement about Kentucky, Ohio, and Virginia were all referenced, notably Ohio with its recent adult use flip as an immediate growth potential. M&A was consistently viewed as a key strategy for growth. Market entry, consolidation, declining valuations in public and private sectors are creating attractive opportunities. Pursuing either greenfield and transformational M&A deals. Interesting that that's been talked a lot about, but haven't seen much there. Refinancing opportunities emerging. As we know, there's a lot of debt that needs to get rolled. And then distress in the space, taking advantage of that to scale up portfolios through M&A is another opportunity for the well-capitalized operators.
It sounds like, were there a lot of TerraSend references in the M&A answer?
Yeah, that probably was the most, like, if you tagged into that, they were probably the most talked about.
That sounds right.
Well, that's cool. I'm going to start screwing around with the Notebook LM. Add that to my. I'm probably 90% Chat GPT. Well, I should use Grok more too, since I'm paying for X Premium. I might as well use Grok a little bit more, and I do dip into that one as well. Just
Grok's pretty incredible. The new Grok, especially since you're paid, it's legit.
Well, guys, good to chat today. Colin, great to have you on the show. Appreciate you taking the time to join us.
Thanks for having me, Jesse. And Morgan.
Fun.
Appreciate it, guys.
Fun chat. Morgan, always good to talk with you. We'll be back next week, I think on Thursday. I'm heading out to our farm. We're planting Salisbury Canyon Ranch early next week. That's our 1,900 acre ranch in Santa Barbara. Not planting 1,900 acres this week. We're planting the first 65 of our 187 acre cannabis permit that we have. So that's about 2.8 million square feet, which is a massive undertaking. So thousands and thousands of what we call seedlings, little plants, about 1 or 2 inches, are going to go into the ground. So we're going to be out there on Monday and Tuesday capturing a bunch of footage of that. So super excited to see all the plants in the ground. It's going to be beautiful and a huge milestone for our firm, but should be back in plenty of time for the show on Thursday. So thank you guys for joining us. Thank you all for listening. Thank you all for watching, and we'll see you next week. The views expressed in this podcast are provided for informational purposes only. Nothing we said should be considered research or recommendation. All investing involves risk, including the loss of principal.